close to an all-time high, and we actually see more upside from here throughout 2026, entirely driven by earnings growth. We actually expect the multiples to compress a bit from the current levels. I think the good news is the earnings growth has been very strong in the US this year, and we think it continues to be strong in 2026. Our target is 7-8% upside from here. Earnings growth probably a bit better than that, and so by definition, we do expect multiples to come down a bit.
And then, on another, in the same perspective, there's increased concern about AI concentration and perhaps frothy tech valuations. What does the S&P 500 look like without the Magnificent Seven?
I think the good news this year is we've actually seen stronger performance and earnings across the board. Yes, the AI companies and large cap tech continue to lead in terms of earnings growth, but in terms of performance this year, we've seen better performance across more traditional sectors, both from a stock performance perspective, but also from an earnings growth. So yes, AI tech is growing faster, but we've seen the other 493 companies delivering double-digit growth as well. And I think that's a good sign and something we haven't seen in the last few years, and also I think keeps us optimistic that there still are opportunities. Of course, we're looking at valuations. We're not investing in everything across the board in AI, but there still are companies that have reasonable valuations that can, we think, deliver on growth next year.
And in regards to AI capital spending could hit $500 billion next year. In your opinion, are we approaching an AI bubble, or are the fundamentals justifying this boom?
I don't think we're approaching a bubble. I think there are certain areas that look stretched from a valuation perspective. I think the good news is the capital spending that is happening is typically coming with the return, and companies are seeing that show up in better earnings growth, better free cash flow. And so I think there's a lot of parallels being made today in terms of AI versus the dot-com bubble over 20 years ago. And I think there are some parallels, but the reality is I think it's happening much faster. I think the implications across different sectors is much broader. And I expect it to show up in the company results, not just in 2026, but really the next 3 to 5 years, which should sustain the current multiples. But we have to look at valuations as well. We're not investing across the board. We're being very selective about how we do that, both on the public and private side.
And your outlook at JP Morgan sees the US core inflation staying above 3% through mid-2026. Yeah. What does that mean in terms of, or how does it translate in terms of the Fed's easing cycle?
Yeah, I think the Fed will continue to cut, and I think, but I think inflation will continue to stay stubbornly, high above the 3%. And so I don't think investors should be anticipating a massive reduction in interest rates. And so I think this creates a lot of complexities for managing portfolios. Is that you do need to prepare for rates coming down, but you should also prepare for inflation sticking around a bit longer. And so that really calls into question areas like infrastructure that can provide an important inflation hedge. I think it really underscores the importance for owning gold in a portfolio. And I think anytime you've got a market dependent on Fed action and lower interest rates with a lot of geopolitical uncertainty still, I think areas like hedge funds perform very well this year. I think that continues next year, given our view that volatility is here to stay as well.
As for gold, you raised your gold target to $5,300. What is driving that call? Is it geopolitics? Is it central bank buying? Is it inflation or elsewise?
I think it's a bit of all of the above. I think, as I mentioned earlier, I think there's still a lot of uncertainty, a lot of geopolitical uncertainty, a lot of concern around the U.S.'s position in the world, the Fed, et cetera, the budget deficit in the U.S. And so I think all those factors, combined are causing gold to move higher. And so we think that continues to be the case next year. We've got a pretty aggressive target, 5,300, about 25% or more upside from current levels. And so for clients that missed out this year and didn't fully allocate to gold, we think there's another chance to slowly build that up to a higher position, because I think gold is going to be that asset class that can protect you when other places like equities and fixed income perhaps don't play out as planned.
How much should gold constitute of this portfolio?
Yeah, it really varies client by client. I think in general, we used to see clients owning 3%, maybe up to 5%, and most of the clients we work with have now kind of thought about 5% being the new baseline, and some have gone even higher than that. So I think anywhere between 3 and 7%, with most clients owning somewhere around 5%, if not slightly more. It depends on the situation, but generally speaking, more than we have in the recent past for sure.
And for investors in the region, in the GCC, so we're talking high liquidity, we're talking dollar-pegged currencies, what should a balanced, resilient portfolio look like in 2026?
Well, since it is pegged the dollar, it's a lot of the same. So I think you should own U.S., you should be overweight the U.S., and within there you should be overweight sectors like technology, financials, and healthcare. I think looks especially interesting. But then you should also be owning European equities unhedged, because I think the beauty of European equities this year, the performance has been more or less in line with the U.S. in local currency terms, but when you translate that to U.S. dollars, performance is actually much, much stronger because you get the benefit of the euro strength. So going forward, I wouldn't really change that playbook. I would still own European equities unhedged, at least a neutral position, if not slightly overweight, and then combine that with an overweight to the U.S. centered around technology, financials, and healthcare.